there's an exam called the Enrolled Agent, EA. So if you don't want to take the CPA, you could take the EA exam. This is the highest level exam that's approved by the IRS. So if you pass all 3 EA exams, then you can do taxes. You can charge people to do their taxes. So this is an exam that's provided by the Internal Revenue Service, the IRS. Of course, if you have a CPA, then you can also do taxes and charge people. So as far as I understand, those are the only 2 certifications you need to do taxes. You can do your own taxes if you want, and you could even do taxes for other people, but you can't charge money. If you do charge money, technically you do need these certifications. Of course, not everybody has them, and by passing a test doesn't mean you're an expert at these. But the CPA, Certified Public Accountant, is definitely at a higher level than the EA. So the CPA, it does dig a lot deeper into certain topics. The EA dives really deep into taxes. The CPA, taxes are just one part of the CPA. So it's kind of like a high level CPA. Just trying to get like more of a website that gives just kind of bullet points on what. Okay, CPA exam. Investopedia is usually really good at explaining things. Let's see if they have a page. The CPA is a substantial undertaking and the final step to becoming a certified public accountant. Before taking the exam, you must pass undergraduate and graduate level classes. So you cannot just take the CPA. You have to have a certain number of credits in accounting in order to even take it. The CPA exam contains 3 sections made up of 200 multiple choice questions and 22 task-based simulations, and 1 discipline section of up to 82 multiple choice questions. So the 3 core sections are financial, accounting, and reporting, auditing and attestation, and regulation. So it's 3 separate exams. It's pretty tough. It's a grueling test. And it could take a number of years to pass it. But the EA is another route to getting that approval to charge for taxes. I started studying the EA. I'm not sure if I want to do taxes. It's just more just learning and maybe content for the channel. So there's 3 sections to the Enrolled Agent. Let me see if I. So to become an enrolled agent, you actually have to go through the IRS and get a PTIN, Prepare a Tax Identification Number. So I think it cost me $20 to get this number, because in order to take the test, you have to enter your PTIN number. Because when you do pass it, then you'll have that credential. I want to see if it just special enrollment examination topics on enrolled agent. And there's always a ton of websites. So the 3 tests, and you don't have to take it in any order. Individual taxes, That's what I'm working on right now, individuals. That's part one, but you don't have to take part one first. Business taxes is part two. And then representation, practice, and procedures is part three, which is the easiest part. I'm just going to take it in order. I'm not sure if I'm going to actually take it. I'm just kind of learning because it's just for fun. Sometimes I get bored and do these things, but this seems to be the best company. It's called Hawk International, and I'm paying $50 a month to have access to their content. So they do break down each part of the exam, and then they give you a lot of test questions, things like that. But let me know in the comments. We could talk about stocks as well. But I'll just show you. So it's 480 pages, this guide. This is just for the test one, the individual taxes. So if you want to learn about how to prepare taxes for individuals, you go through this and you'll be a master. So there's 18 units in this in part one. There's preliminary work and taxpayer data. That's unit one. Unit two is determining filing status of residency. Then dependency relationships is unit three. Unit four is taxable, non-taxable income. I do find taxes interesting. So that's kind of why I'm doing this. Part five is investment income and expenses. Part six, calculating the cost basis. So when you buy a stock, you need to know your cost basis, because when you sell it, you need to figure out whether you have a gain or loss. Also, if it's a short-term or long-term, depending on how long you held it. If you held a stock under 1 year, then you have to pay ordinary income taxes, the higher tax rate. If you held it for more than 1 year, you pay long-term capital gains rate, the lower tax rate, which could be as low as 0%, depending on your income. Can't get this last. Okay. Okay. Unit 7, capital gains and losses. Then Unit 8, non-recognition property transactions. Unit 9, rental and royalty income. Unit 10, other taxable income. Unit 11, adjustments to gross income. Unit 12, standard deduction and itemized deductions. Unit 13, individual tax credits. Unit 14, the ACA and the premium tax credit. And every year they update these examination booklets because it changes every single year. Taxes change a lot. Unit 15, additional taxes and credits. Unit 16, individual retirement accounts. Unit 17, foreign and financial reporting. Unit 18, estate and gift taxes for individuals. So right now I'm on unit 0 before unit 1 is unit 0, which is all the changes for the year. I went through unit 1. These are just my notes. It just keeps me on track. Unit 2, I went through. Unit 3, Unit 4, Unit 5. I'm kind of taking a long time to do this. Just I did Unit 6. I'm currently on Unit 7. And it's such a grind, like studying. Like it's just so boring sometimes. Like when you read a book, something you're interested in, it's fun. But when you have to study for an examination, it get pretty boring. So sometimes I procrastinate. But anyways, so they start with an introduction. telling you about the exam. There are 3 tests: part 1, part 2, part 3. The first is individual taxes. So if you're doing taxes for like a family member or your own taxes or a friend, that's individual. But say your friend owns a business and he wants you to do his taxes, it's a little different. So that's business taxes. And part 3 is representation, practice, and procedures, which from what I understand is the easiest of the 3, but I haven't even looked at that yet. So you'll have 3.5 hours to complete each part of the exam. So you have to do, in part 1, you have up to 3.5 hours to complete all the questions. But the good thing about this website is that it does go through all the topics, but it gives you a ton of test questions, practice tests, and quizzes. So it's good to do that. They also have a lot of videos, so you can watch instructional videos. I think this going through the booklet is the best, but the videos and the practice tests kind of nail things down. This is just information on like what to do on test day. And all the questions on the exam are from the content. So these companies like Hawk International, the way they make money is they take the IRS exam and they try to put it into a format that's more user-friendly. But if you want all the detail will be on the IRS website, because that's where it comes from. That's a source. So it's possible a company like this excludes certain information just because there's just so much information to put into these. Exam strategy. So for each multiple choice question, there's 4 answer choices. And there are several different question formats. During the exam, you should read each question thoroughly to understand precisely what's being asked, and be careful when problem. What I like about this test is it's not tricky. I remember taking the GMATs and what other exams? I did the enroll. I became a notary public actually pretty recently, like a couple months ago. That was a little tricky too. They try to like throw questions in there and it's very nuanced. But the thing I like about this test, it doesn't seem tricky. It seems pretty straightforward. There's nothing, at least from what I experienced. So this is more of a direct question. Which of the following entities are required to file Form 709, United States gift tax return? And if you're not sure, I would just, and I do this all the time, like, what is Form 709? Form 709 U.S. gift and generation skipping transfer tax return is required if any of the following apply. An individual makes 1 or more gifts to any one person other than his or her spouse that are more than the annual exclusion of the year. So who is required to file Form 709? Well, you need to file Form 709 if in any tax year you give gifts exceeding the annual exclusion amount, $19,000. So if, say you're in your 80s and you want to start giving stuff to your kids and grandkids. So say you have a second car, right? An $80,000 second car that you don't use. It's like your prized possession, but you want to give it to your grandson. Well, it's above, you could give up to $19,000 as a gift without worrying about taxes. But if it's above $19,000, then you have to use Form 709 to report it. You never have to use these forms if you gift something to a spouse, because what you own, your spouse owns. So it's not like Like if I gave $100,000 to my nephew or niece, of course, taxes will have to be paid, because if people were allowed to just give and whatever money they can, then everybody would be doing shady business and not paying taxes. You could find workarounds for everything. But in the U.S., it's taxes are the biggest source of income for the government. Okay. Then you have format 2, incomplete sentence. Supplemental wages do not include payments for accumulated sick leave. So supplemental wages. So what I would do, if you're not sure what is supplemental, but if you go through the booklet, you would know what a lot of the stuff is. Although there's a million terms, so it's hard to know everything. Supplemental wages are additional payments to an employee in addition to their regular wages. They include overtime, bonuses, commissions, and more. If an employer provides supplemental wages, they may be required to hold taxes from these payments. So you can't just give an employee a ton of money and not worry about taxes. There's ways to give employees money without just salary. There's the bonus, and then you can give them, you can give gifts to employees, but taxes must be paid. You can pay for employees' tuition for college. So supplemental wages do not include, well, they definitely include vacation day pay. I never used this before, but yeah. So they definitely include vacation pay, because supplemental includes overtime, bonuses, commissions, and more. Travel reimbursements paid at the federal government's per diem rate. It definitely includes accumulated sick leave, because if you take a sick day, you're getting paid. That's part of your supplemental wages. I think it's non-deductible moving expenses, but I'm not 100% on that. I would have to double check. Let me know in the comments. Do they have the answers? Okay. These are just examples. Format 3, all the following except. So 5 tests must be met for you to claim an exemption for a dependent. Which of the following is not a requirement? Citizen or resident test, member of household relationship test, disability test. Okay, let's get to the meat of it. 10 steps for the exam. Step 1, learn, gather information. Like I said, you have to get your P10. I think I paid 20. How much is a P10? I think it was $20. Yeah, 1975. You just go to the IRS website. It took me 2 minutes to get a P10. It's a unique identifier. It's kind of like a social security number. So you have your P10 number. So when you do file someone's taxes, you write your P10 on the bottom of the tax return. I'm bad with studying. I have good intentions to study, but I get lazy, or I'm reading the material and I'm not even paying attention. I'm thinking about what happened throughout my day. So you have to, I guess, reread it a second and third time. That's pretty common. You just want to get through the material as fast as possible without going too fast, because you won't really grasp that much the first time. It's the second and the third and fourth time is when it starts coming together. But if you're good at this stuff, like if you start learning this stuff, then you could identify things you need to do and tell your accountant. You could even find errors from. And I've found lots of errors with my accountant. Also, not just errors, but your accountant might not know your entire life inside and out, but you do. You know your life. So if there's a tax credit that you find out about, you can tell that to your accountant. So I think this first section is just the changes from prior years, like what's different. Um, but let me know in comments if you want to talk about stocks. Okay, so let's go through some of these. These pages are pretty important. They're definitely going to show up on the exam. Okay, legislation affecting the 2024 tax year. So there were some changes in 2024. So if you study for the test in 2023, these items are brand new, and there's the Federal Tax Disaster Relief Act of 2023. This just provides like a tax credit if you're in a disaster area. There's a Secure Act 2.0. So it made some changes to, and some of this stuff is so nuanced. So in order to really understand it, you have to be doing taxes like day in, day out. You can't just read it once and then remember everything. Because a lot of things, like everybody has a job where there's things that they do every day, like, so they'll never forget those things. But then there's some things that only occur once or twice a year, and you always seem to forget those things when it happens. So here's an interesting one. So 529 rollovers. So beginning in 2024. So, and if you don't know anything, you do what is a 529 rollover? You could just do that. A 529 rollover is a movement of funds from one state's 529 plan into a different 529 plan. So 529 is like saving money for your kids' college, and there's a tax benefit, so you don't have to pay taxes generally when you do these things. So beginning in 2024, owners of 529 plans can transfer unused funds directly to the plan's beneficiary Roth IRA without incurring federal tax or the 10% penalty. So say you had $50,000 in your 529 plan for your kid. Let's just make it simple. Say you had $5,000 in the 529 plan for your kid, right? Because you wanted to have that money to go to college, and say your kid passes away at 15, a car accident. So obviously your kid's not going to college. So there's a way to roll over that money into a Roth IRA instead of losing it totally, and avoid penalties. Scott, are you buying CRCL? Hey, Kevin, what's up? Let's take a look at CRCL. So just 2 days ago, I did my hair transplant surgery, my second one. So I hope I have a nice full head of hair in 6 months. I don't know if you could tell, it's a little swollen right here on my forehead. I'm so vain. I probably think the song is about me. So CRCL. So let's take a quick look at Circle Internet Group. What happened? I wonder why this is not working. Oh, it's something with the formatting. Okay, what hair looks great? Thanks. Yeah, I don't even think I really need it. I don't know why I did it again. It's not cheap. It's like $12,000. Okay, Circle Internet Group. Let's look at 22 billion. Decent sized company. They're trading at 108. Let's see. Okay, there's no information because they just IPO'd. So they IPO'd at, looks like 31, and they went up about 300% already. It's on a real high level. So they've been around 11 years. 1.4 billion of revenue. That's not too bad. If you want to learn about their past financials, I would just go to their website because they have to issue a press release when you go public. So there has to be financials somewhere. Legally, they have to provide it. Circle K pricing of upsize IPO. Well, obviously there's no 10K and 10Q. I was thinking there may be, let's see if in the, it has to be mentioned somewhere in one of these reports because in order for people to invest, they need that information. Circle K registration statement for proposed IPO. It'd be nice if it was somewhere convenient without us chasing it. USD circulation, Circle intends to bring hash note. I'm not going to make it easy on us. So what do they do exactly? Okay. So Circle CIG doing business as it's a peer-to-peer payment technology platform that manages stablecoin USDC, a cryptocurrency, the value of which is pegged to the US dollar. Yeah, USDC is a crypto asset, but it moves. It's correlated to the US dollar, which I think is a great way for people to get into crypto, because if they're concerned about Bitcoin and Ethereum, since there's no intrinsic value in crypto assets, they should be comfortable buying USDC because it moves with the dollar. USDC is the second largest stablecoin worldwide. So it's behind Bitcoin in terms of valuation. It's designed to hold a near stable $1. Majority of its stablecoin collateral is held in short-term U.S. government bonds. This seems like a really good crypto play. The company has received 135 million of venture capital from 4 rounds of investments, including 50 million led by Goldman Sachs. That looks pretty good. They IPO'd for 1.1 billion, valuing the company at 6.9 billion. In September 2018, Circle, along with Coinbase, released a consortium called Center, which launched digital USDC pegged to the dollar. Yeah, this seems really interesting. So what's so how do you value this company? Circle K. Yeah, I was talking to Victor, Victor H Investing, and we're looking into starting our own hedge fund. My friend is actually a lawyer that supports companies that are building hedge funds, like the legal part of it. So I'm going to talk to him. So I'll let you guys know how that goes if we start our own fund. Past performance. Okay. So Simply Wall Street has performance information. They do have positive free cash flow. Isn't that interesting? I didn't think they'd have positive free cash flow. It's nearly 300 million in 2024. Let's see their revenue. Look at that revenue. It was pretty much nothing. Now it's almost 2 billion. So this gives us a lot of information. So let's just let's plug that in. Let's go with 300 million. And if we grow at 50%, so I'm at $74 a share. So it would have been a good stock to pick up IPO. It would have been hard to get it at that level, because as an individual trader, you generally can't buy the stock until it starts trading actively, and by that point, it's already past the point of picking up at a good price. But let's try to learn more about the company. This says 10K 10Q, but they don't have it. I don't know what the hell this is. So Circle K. Okay, let's just go down the list, get some more info. 10 shares, nice. $80. That's good. I think you'll do well. I mean, you're already up, what, 25%? So Simply Wall Street is at 65. That's really close to what I'm at. I'm at 74. That's interesting, right? And if you have Simply Wall Street, if you're paying for their service, you can see how they come up with the valuation. Okay, it's right here. You hit data, and then you can see how they calculate it. I mean, DCFs are pretty similar. We do the same exact thing. It's just the inputs are slightly different. So you can see I'm using a 7% WACC. They're at 7.9%. And the way they calculate the WACC is they use the risk-free rate. So that's your rate, assuming you invested like in a AAA U.S. Treasury bond, which is considered risk-free. And then they take the levered and unlevered beta. They take other metrics. Do you guys know what this is? Levered, unlevered beta? Levered just means debt. So that's the that would be the WACC with debt. Unlevered is without debt. But what they do is they take levered beta and then they re-lever it. But it's the same exact number in this case. And they calculate 10 years of free cash flow in the future. So they start out with 372 million. I started out with 300 million because that's pretty much their most recent. And I grew it to 680 million in year 3. By year 3, they're at 575 million. But they go out 10 years. So they're going out to $1 billion by 2034. And then they take the terminal value after year 10, which is 4.7 billion. My terminal value is 16 billion. And the reason we get so close is because they're summing up the next 10 years of free cash flow and then doing a terminal value. I'm just summing up 3 years of free cash flow, then a terminal value. But anyways, let's see what else we can learn about the company. So they're pretty much debt free. They had $1 billion of debt in 2021. Now it's down to 37 million. So once they IPO'd, well, they did IPO recently, so they paid off the debt well before IPO. So they're pretty much debt free. No dividend, of course. The CEO salary, $900,000. So that's what when you grow and scale a company, a lot of your salary comes from the investors. So if there's investors putting money into the company, then that pretty much goes in your pocket. So if you're the CEO, in this case, he's taking a salary. Is it a he? Yeah, it's a he. He's taking a salary of $900,000, but it's not his money he put into the company. It's the investors' money, or if there's debt, of course. Yeah, leverage just means debt. It's just so that's pretty much when they say we're leveraging our investment, we're adding debt. That's how they're growing. But this company wouldn't be using much debt. as we saw earlier, very little debt. Because when you're losing money, you can't take on debt. I mean, you could, but the problem with debt is that you have to pay it back with interest. When you take on equity investments, then you don't have to pay it back. That's the way to kind of grow a business. Generally, in the beginning, is you grow with equity. Debt is like a last option if you're cash flow negative. So if you see a company that's losing money and adding debt, that's a big red flag, because at some point they will go bankrupt, because the definition of bankruptcy is when you cannot pay back your debt. You default on your debt payments. But if you're a profitable company, debt is a great tool to grow your business because it's a lot cheaper than equity financing. Okay, so ownership breakdown. What do you think of the LEAP options? I mean, I'm not a huge fan of options really, but if you have a pretty good hunch on a company, LEAPs can be a really cheap way to kind of get some upside potential. But it's risky, right? Because a lot of times you end up not making any money, and it ends up going away because your option just expires worthless, which happens like 95% of the time. So half the companies owned by the general public, 30% by VC and private equity firms, 10% by institutions, and 7% by private companies. So I'm always curious, like, who owns the company? Because it does give you a little information, a little insight. General Catalyst. So it seems like a pretty legit firm. General Catalyst, been around 25 years. And they invest in early stage companies. They invested in over 800 companies. So that gives me a little more comfort when I see a company that has invested in some successful companies. Airbnb, HubSpot, Kayak. So Gusto, the payroll company, Stripe. So it looks like, and when you have a big investor like this, then you have someone to go to if you need money, because they probably have deep pockets. Kind of like if Berkshire was an investor in your company and you needed funds just to get through the year or to acquire another company, you can go to your bigger investors and give them like preferred stock or some type of deal. In 2021, they managed more than $8 billion in assets. In 2022, it raised $4.6 billion for its 11th general fund. It was ranked as it was one of the largest venture capital firms. Okay, but that's General Catalyst. Let's go back to Circle. So Briar Capital is probably another VC firm. It's a VC in healthcare, fintech. It does help to have a big company, $1 billion fund, because if we own the stock, we don't really have like $100 million if the company needs to like acquire another company. But if they go to General Catalyst, they might. Fidelity owns 6%. Martha Burns, this is probably one of the founders. Let's skip that for now. Fenway Summer Ventures. So this gives you a little more comfort if you're investing in a company. You can see in 2021 they had 125 employees, but now they're up to 900. So if you're adding 700 775 employees, that implies there's some business and there's some demand. So it gives you a little more comfort. Not a lot of employees, but they did add employees. Who are the investors you admire the most? I mean, there's so many. And Bill Ackman, he's a pretty shrewd investor. I like Bill Ackman. But yeah, there's a lot. So it trades on New York Stock Exchange, Börse München, and Deutsche Börse. Let's see what they say about it. It's a platform, network, and market infrastructure for stablecoin and blockchain applications. They provide a suite of stablecoins and related products that include a network, utility, and application platform for organizations to benefit from stablecoins. Its stablecoin network comprises Circle stablecoins, tokenized funds. It is an interesting company. I'm not a huge fan of investing in crypto. What I like to type in is like, what does Circle Internet Group do? If you want to get a little more like a dumbed down version, Circle Internet Group. But a lot of times it's a copy and paste from like Wikipedia, so you don't even get more information. So I see it works in stablecoin. Is it like a brokerage firm similar to like E-Trade, but mainly people who buy and sell stablecoin? Is that like the purpose of it? Let me know. Well, you could go to investor relations to get a little more information. Let's see what it says. Okay, so its IPO was 34 million shares. So what's $31 a share when they IPO'd? And they're offering 15 million shares of Class A. Okay, so it's 14.8 million shares of common stock plus the 19.2 million. That's how they get 34 million. In connection with the offering, stock has granted the underwriters a 30-day option to purchase up to 5.1 million shares. Okay. Yeah, they use USDC stablecoin, but I'm just saying, what do they do with it? Is it just like E-Trade, right? The way E-Trade makes money is it's like a broker. You can go to their platform and buy stock and hold your stock in your E-Trade account, and then of course you can sell stock. So is it working the same way, where if you want to buy USDC, they help you do that, and it's kind of like your bank account, so to speak. So that's where you keep your assets. I'm obviously doing more than that, but I think that's the main idea. If So as you know, taxes are due April 15th, but you could file an extension. If you file an extension, you have until October 15th. That's right here, October 15th. So you have 6 more months, which a lot of businesses do. They file extensions. FBAR due date. The due date for the FBAR, which is foreign bank and financial accounts, coincides with the filing of the federal tax return. So you get a 6-month extension if you file for it. But if you owe, the way this works is, say on April 15th, you owe 10,000 of taxes. You might not know that because if you file an extension, like you have your tax returns are complicated, so you file an extension, or you're a business. Lots of businesses file the extension. Then you have until October 15th to officially file your tax returns. But you still have to pay the $10,000. If you don't pay the $10,000 by April 15th, then you'll get hit with a penalty. Maybe a 10% penalty. So instead of paying 10,000, you have to pay 11,000 October 15th. But you might not know how much you owe, so you can just estimate. Like your accountant can say it looks like around 10,000. So you just send in a check for 10,000 to the IRS by April 15th, and then when you file your returns, if it happens to be 9,500, then you just get a $500 credit. So most people use standard deductions. So if you're single, or you, because when you file taxes, you have to classify yourself as something. If you're single, like you're not married, you could just classify yourself as single. But if you're married, you can either classify yourself as married filing jointly or married filing separately. It's better married filing jointly, that you'll get more out of it, more deductions. They're assisting Japan with the stablecoin. Yeah, I'll be right back. Let's talk more about stablecoin. So the way it works is, let me add a new tab. So most people use the standard deduction because it's just easier. So we'll just assume you're single, just to so say your your taxable income, like your gross income, is 100,000. And then taxes. So every paycheck, taxes get taken out of your paycheck, right? So let's just say 25,000 were taken out of your paycheck throughout the year. So your net is $75,000. So the way your accountant would do the deduction is they would probably take the standard deduction. It's a lot easier. So they would give you the 14,600 standard deduction. Damn it. Yep. I'm doing I did a 25% tax rate. Let's just say that's your tax rate, 25%. 25%. So if he applies the standard deduction, right? So now he calculates your taxes should have been 21,350 for the year, because he's assuming you had these deductions, like maybe you gave money to charity, blah blah, but he's not adding up what you actually donated. This includes like the mortgage, the interest you paid on your mortgage, all your deductions. He's taking all your deductions, and instead of actually adding them up, he's just giving you the standard. So now you're I'm on page AGI 16. Come on. So MAGI is modified adjusted gross income. So this is your gross income. Okay. So the $100,000 is your gross income, right? According to your W-2. But your accountant has to take into account your deductions for the year. Like I said, if you paid interest on your mortgage, things like that. So this is your MAGI, modified adjusted gross income. So you pay taxes on your MAGI, not on your gross income. So you should pay taxes based on 85,400, because he's taking the standard deduction and applying it to you, which 98% of the time that's what happens. So your modified adjusted gross income, very rarely people itemize. I'll explain why, is 85,400. So according to your accountant, you should have paid 21,350 in taxes. for the year. But you actually pay $25,000. If you add up all the taxes on all your paychecks for the year, it comes out of $25,000. It's on your W-2 form. It gives you that total $25,000. So this would be on your W-2, $100,000, $25,000 taxes net. So you, in essence, you overpaid $3,650. So that's your refund, $3,650. Now this is a very simplified approach. There's usually a lot more things going on. So that's what you'll get from the IRS, a check for $3,650 because you overpaid. Now, why do people take the standard? It's just easier, and most people fall below the standard. Some people, if like I don't have that much in write-offs, like I paid off my home, so I have no interest to write off. You do get deductions from different things, like if you let's see, common deductions for taxes. Well, the home mortgage, like I said, is a big one. Maybe if you put you did something to your home, like you added a solar. You got solar panels on your house. That's a deduction, right? But most people don't even get over the 14,600. So it's just a lot easier for the accountant to just do the standard. But if you did solar panels on your home, then your accountant would not do the standard deduction, because I remember when I did solar panels, that year alone, I had a $40,000 deduction. So my accountant would not do the standard. He would itemize. Itemize means list out every single deduction. So maybe the interest on my home, say I paid $700 a month, so 700 times 12. And say I donated to charity. Say my old car was beat up and I didn't really need it anymore, and the Kelley Blue Book value was, $1,500. So I donated my car to charity. So that's a deduction. A lot of times you forget because there's so many things to add. Property taxes. Maybe if I had a loss on say I bought like AT&T stock and had a loss of like 1,700. That's a deduction. So he would itemize all my deductions and he would see. So in this case, he wouldn't do the standard. He would itemize, because my itemize are much higher than 14,600. If I didn't do the solar that year, then he would just do the standard, because you could see these three 11,000. So even if there was some other small thing for a few hundred, he would just do the standard. So in this case, he would definitely itemize, and he would see that my modified adjusted gross income is 48,400. So if my tax rate is 25%, so I should have paid 12,100 in taxes, but I actually paid 25,000, because when you start your job, you have to pick what bracket you want to do. Are you single? Are you married, filing jointly? Are you married, filing separately? How many dependents do you have? If you have like 5 kids, that's a big deduction. So in this example, I should have paid 12,100 in taxes. I actually paid 25,000, so I get a big fat refund of 12,900. So that's why you should itemize. if you're an individual, you usually take the standard deduction. But if you're like if you have a pretty high income and you have a lot of things going on in your life, you spend a lot of money on different things, then you'd probably itemize because it's probably be better off. So these are the standard deductions. So if you're married, you can either choose marrying filed separately and take the 14,600 deduction, or married filing jointly. And that means if you're married filing jointly, you could do the 29,200 between you and your wife. So so that means each of you could do 14,600. What you see is just half. It's pretty much the single twice or married filing separately twice. But the thing is, say you're married and your wife, say she doesn't work. Say you have 3 kids and she stays with the kids, so she doesn't have a salary or deductions. You could take the entire $29,000 deduction yourself because it's applied to both of you. So that could be really beneficial. It's much beneficial to generally, not at every single situation, but generally, married filing jointly is better off than marrying filed separately for tax purposes. Or you can do QSS, qualified surviving spouse. So you have to, in order to I want to show you on here. I think it. So it's a least common description, QSS, because you would have had to, it's if your spouse dies and you're the surviving spouse. And it's not only that. Okay, here it is. Just visually, I think it's easier. So in order to choose qualified surviving spouse for taxes, you can't remarry. If you remarry, then you have to do either married filing separately or marrying filing jointly. You can't choose qualified surviving spouse. So if your spouse passes, you do not remarry, and you have to have a qualifying child. So you have to have a child as a dependent in order to use QSS. So say, for instance, you're married and your spouse passes and you have no kids, no dependents, you cannot use QSS. You have to use the single status. You can see QSS. You see how beneficial that is because your deduction is 29,200. So you get a big deduction because that alone, because it would only be 14,600 if you did single, but if you did QSS, you get to double, and that alone, that's a $4,300 payday for you because you get a deduction of 21,900. That's standard. If you itemize it, it might be a lot more. But if you itemize, it takes time, so you might end up spending more money with your accountant to have them go through all your stuff. If you're really organized, then and you provide it to them, then it's great. But if you have your accountant doing all the work, they may charge you $500 for a couple hours of work, and you save $200 taxes. I find this stuff really interesting, but so you do have to qualify for these things. You can't just pick QSS. And to be QSS, you have to have a qualifying child. It cannot be a foster child. It cannot be a parent. Because a dependent, if you file your taxes, your accountant says, how many dependents do you have? And the more dependents you have, the more deductions you get. So you can't just say, oh, I have 100 dependents. You just make it up. Yeah, everybody in my neighborhood is my dependent. And you get a huge refund. But you can't do that. It has to be a real dependent. A dependent can be obviously a child. It could be a foster child. It could be an adult. A dependent can be your parent. If you're the one responsible for them financially, it could be your sibling too. It could be your spouse's sibling. The thing is, but for purposes of QSS, it's more restrictive. But a dependent can be a wide range of individuals. So, and the nice thing about they added a higher deduction if you're over the age of 65. So say you're so it's an additional $1,550 for MFJ, QSS, or MFS. It's an additional $1,950 for single head of household. There's a lot of stuff to remember, right? Head of household is another. I actually really enjoy taxes. I think it's really interesting. Alex, what's up, buddy? Okay, so head of household, you can be single, divorced, or legally separated. And you have to pay at least half of the house expenses. At least half of the expenses in the home must come from you in order to qualify for head of household. And you also have to have a qualifying person live in your home at least half of the year. So you can't just say I'm head of household and I have all these dependents, but nobody lives there. I mean, you could have a dependent. Maybe your sister is disabled, right? But she has her own apartment. The next block over, she has her own studio apartment, but she's dependent of yours. You pay her bills. Or maybe she collects $1,500 a month in benefits, Social Security benefits, or disability benefits. You take that money yourself, but you pay her rent and food and stuff like that. So head of household is the other one. So there's single, married filing jointly, married filing separately, qualified surviving spouse, head of household. Those are the 5. I don't think I missed anything. So the nice thing with the IRS is when you're over 65, say you're single, your standard deduction is $14,600. Let's go back to this example up here. So let's just say $100,000 salary, you pay $25,000 taxes, your net is $75,000. And let's say you did the standard, which is $14,600. That means you get a refund of $3,650 because you overpaid $3,650. But let's just say you're over 65. Say you were 64 last year, and this year you're now 65. So now you get even more deductions. So maybe in 2024, well, 2023 tax year, say you were 64. It's your age on December 31st. Whatever your age is on December 31st dictates everything. So let's just say in 2024, because you would file your 2024 taxes in 2025, you're 65. Let's just assume everything's identical. You have the same exact income, 100K. Your company takes 25% off for taxes, so your net is 75K. Last year, your standard deduction was 14,600, but now that you're over 65, you get a bonus of 1950. I'm assuming you're single in both scenarios. $1950. So now your standard deduction goes, it's higher. The more deductions, the better. So your standard deduction goes from 14,600 to 16,550 because you get that bonus. So now your refund in 2025 or 2024 tax year is 4138. So you get an extra $488 for being older, which is nice. Of course, if you itemize your deductions and say your itemized deductions are higher than standard, then this is kind of a moot point. It's irrelevant because no matter what age you are, if you itemize it, that's what it is. So you don't get that bonus. And accountants miss this stuff all the time. There's so many nuances. So these are the bonuses for 65 or older. Yeah, 16,550. You also, any filing status, a taxpayer had net earnings from self-employment of at least $400. So if people don't usually report this stuff, but let's just say you do dog sitting on the side for friends and family. Say you made $300 from dog sitting for the year. You don't even have to report that. But if it's at least $400, say you made $1,200 in dog sitting, right? I'll show you the difference. So let's just do a regular. I'm just assuming you're not 65. You're just whatever age you are. So say your accountant did your taxes. Your gross income was 100K. You paid 25,000 in taxes. So your net is 75K. He applied the standard deduction, and now your modified adjusted gross income comes down to 8,500. That means you should have paid 21,350 in taxes. So that's your refund, 3,650, right? But let's just say you told your accountant, I actually made $2,000 for the year. You probably wouldn't even tell them, but let's just say you were honest. And you said, I made $2,000 from dog sitting. Let me add a row. So you have to add that to your income. Anytime you receive money, you have to pay taxes on it. So say you made $2,000 of taxes. So now your modified adjusted gross income goes up 2,000 from 85,400 to 87,400. So that means you should pay taxes on that $2,000, right? So your accountant calculates 21,850 in taxes, even though your company deducted 25,000 for the year. So you overpaid 3,150. So that's your refund, 3,150. So you get $500 less for being honest. I thought you report all income regardless of any threshold. You don't report all income regardless of threshold. In this example, there's a few examples you don't. Yeah. This says $400. So the taxpayer had net earnings from self-employment at least $400. So if it's under $400, according to the IRS, you don't have to report that. Because it's kind of like if you go to the movies, right, with your friend, and you're like, oh shit, I forgot my wallet. And your friend gives you $20 for the movie. Do you have to report that? I mean, that is money you're receiving. So there, I guess there are thresholds. In that case, you'll see a bunch more. But no one would even. I remember when I did Rover. It was such a great gig. I made like $15,000 for the year, but PayPal didn't provide 1099 forms unless you were over. I think it was like $20,000. So I was like, it was great. It was so great. Like I didn't want to like hit that 20,000. Yeah, it was 20,000. So if you were under $20,000, they didn't even provide you a 1099. So I didn't have to report it to the IRS. And there's no way they would figure it out. And it's so hard for them to figure it out when it's that low of an amount. Like if it was like millions of dollars, then you get nailed. That's why the situation, remember Mike Sorrentino, the situation, he went to jail for tax fraud because he was getting like, like $800,000 of income from, he got like $200,000 from being on the Jersey Shore. And then he did these guest appearances and got like $50,000 each appearance. So his income was like, I'm just making this up, but I don't remember his exact income, $800,000. So he should have paid, he probably was like the highest tax rate, say 35%. So he should have paid $280,000 of taxes, but he just didn't report a lot of it. He only reported like his $200,000 income from the Jersey Shore, because that when you get income from a company, that company has to report that income to the IRS. So it's hard to like get around that. So he only reported the $200,000 of income, but every time he went to a special event, they would give him $50,000 in cash. But he thought it was not traceable, so he didn't even report that money. So he underreported $210,000 to the IRS. But the IRS, they knew, because they knew he had more money. Because what he did was, see, so when you have a $10,000 transfer in a bank account, it triggers. It's called a CTR. what's that stand for? I forgot what. CTR banking, currency transaction reporting. A currency transaction report. So when you move $10,000 into or out of a bank account, it triggers something at the IRS level, and they can see that, and they get a report on it. So if I bought a car, right? So I sold $30,000 of stock, right, in my E-Trade account. I transferred it to my bank account, and then I wrote a check from my bank account to the car dealership for like $30,000. It would trigger something with the IRS, but if the IRS wanted to dig deeper into it, they could just see I bought a car. Nothing nefarious. But what he was doing was he was moving like lots of money, like 80,000, 130,000, 215,000 between different accounts. He thought he was being smart by not putting all the money into one account. So he was trying to like move it around so it would go undetected. But he didn't realize if it was a minimum of $10,000, it would get a trigger by the IRS. And then the IRS looked into it. It's like, why are you moving hundreds of thousands of dollars between accounts? And if it was a legit thing, if he was just using the money to maybe invest in things like that, but he was just doing it so he didn't have to pay taxes on it. And then he got hit. Then we went to jail. I thought there was a word that structuring. It's called structuring. So if you want to defraud the IRS, do what Enron did. So this is how Enron got away with it for so long. So as long as it's below $10,000, it would not even show up on the IRS report. What they would do is like, they would like transact $9,999. They would have like a handful of people, and the entire weekend they would just sit there and move $9,999 like tens of thousands of times between accounts. So it would never trigger with the IRS, but they would be able to move, a few $100 million around. And what they were just doing was, in order for them to kind of stay afloat, they would have to report income above a certain number. So like they needed to hit their target. So say like they needed to get 2 billion of income for the quarter, and they only had like 200 million. So they would just sit there for an entire weekend, moving money between accounts. So on like December 31st, they can take a snapshot of their bank account, and you see the $2 billion of income, and then it would move it back into the account. Reporting income is good for loans. What do you mean exactly? It's good for loans. You mean paying interest on a loan? Reporting income, if you're a business, is good because you want to show income, right? If it's legit income, because if you're a company, what Enron did, you can, like, say a customer says orders $1 million of product from you, right? Say let's just do Walmart. Okay, so Walmart, and then Jim's Manufacturing. So Jim's Manufacturing Company, right? He's a publicly traded company, and he needs to show a certain revenue for a stock price to go higher. So he could pretend Walmart ordered $1 million of product. So he would book $1 million as income, right? But remember, when you sell a product, you don't need to receive any money. You can sell on credit. So they would report $1 million of sales to Walmart. So when on at the end of maybe on December 22nd or something, and then in the beginning of January, they would just reverse it out. So they would show that income as of year end. So year end looks great. But then they would reverse it out because obviously they're not going to get any money for it if they just made it up. Alex, I'm not sure. What do you mean for getting higher dollar loans? You mean, are you saying, oh, if you want to get a loan from a bank, uh, you need to show that you have a certain amount of income in order to qualify for a loan? Is that what you mean? Like, is this what you mean? So say I go to say me and you go to a bank, separately, like, um, so we both need $100,000 loan, say, to buy a home, right? So we're both going to the same bank the same day. We don't even know each other. We're at different bankers. We both need let me use a number that makes more sense. So we both need $400,000 loan from a bank to get to buy a home. Say a home is $500,000. We put $100,000 down. And I go to the banker. Obviously, you have to show a lot of information, but like I say to the bank, my income is 90K. That's my salary. And the bank says, okay, that's your interest rate on the loan. And then you said to the banker, my annual salary is 190K. So the banker is giving you a much better rate than me because you're a much lower credit risk. So having a higher salary in your case works out better because you pay a lower interest rate and less funds. Yeah, I mean, you can't really lie. I mean, you could try to lie if you get, um, but I'm talking about the reason, like a company like Enron, they were pumping up their earnings and revenue was because if they didn't hit these targets, then the stock would crash. So they kept inflating their numbers. So they were manipulating the stock market prices. That's what I meant by it. But yeah, the higher your income, the lower your credit risk, things like that. But it's kind of a different exercise because if you don't, like in the situation's case, he wasn't looking for a loan. He was just looking to avoid paying taxes. So he didn't really care. He didn't want to prove he made a ton of money. He didn't really need that. He just wanted to not pay taxes. If you're a business and you need to take a loan, then you may have to. I mean, legally, you shouldn't be lying about your income. But a lot of people do. I pretty much, I would say over 90% of people who work in service industries like waitresses and waiters lie. So if they get a 25K base salary and 18K in taxes in tips, like they're not going to say 43K because then they have to pay taxes on 43K. You can't, like, just to give you an example, So if you make 43K as a waiter or waitress, you have to pay $10,000 in taxes. So you just want the idea is to pay as little taxes as possible, but you don't want to do it where you can get in trouble. But if you're a waiter or waitress, it's almost impossible for them to know. So instead of saying 18, you just say 11, because there's no possible way for anybody to know. So instead of paying 10,750 in taxes, you pay 9,000 in taxes and you save 1,750. Almost, I'm pretty much all people in those industries do that. Like if you're a mover, you're not going to report every single time somebody gives you a tip when you move their stuff. You do want to report some of those tips because it's obvious you're getting tips, but you can't. But yeah. But that's normal. Like that's the IRS knows that, and that's not, they don't even care about that. That's normal. But and it's so insignificant if somebody's trying to save $1,000 for the year in taxes. But like people like the situation who's screwing the IRS for 200K, or millions, you know, that's when it gets. That's why if you don't, if your salary is not that high, like if it's under $100,000, it doesn't pay for the IRS to audit you. You may get audited because sometimes they just randomly audit people, but unless you're making a ton of money, you're probably not going to get audited. And they're so understaffed at this point, they don't even have the time to audit everybody. It's such a bitch because when you get audited, I never got audited before. Then you have to pay your accountant like $1,000 to do all that extra work. Even if you don't even have to pay more. Say they audit you and you find out they have to actually pay you $500 more. You lost $500. You had to pay your accountant $1,000 and you get 500. So I mean, you're not going to probably go to jail, even if you did mess up, unless you're like the situation. Like that was obviously he was trying to defraud the government by moving funds between accounts and trying to open up all these separate bank accounts. Like when it goes that far, that then it shows intent. But if you forgot, or it was something like you just didn't know you had to do that, it would be hard for them to show intent. But anyways, so the tax brackets, indirect tax brackets used. So these are the brackets. And this is all computerized, so you don't have to like manually do this stuff. You just have to type in like a few numbers and it does it all for you. So we'll just assume we're all single. We're all filing as single. So if you file single, right? Okay, so the first 11,600 of income. This is before deductions. After deductions, you might not have to pay any taxes. Why did it look like that? Okay. Say you're single. We're gonna do just do single, just so we don't have to confuse things. If you made 11,600 for the year, you might be a student, or even less than that, 2,500. But let's say you made exactly 11,600 for the year. You'd only have to pay 1,160 in taxes. But you might have deductions too. So deductions will bring it down. Now equals 191,950. Getting hot. Let me turn on the AC. I'm just gonna turn on the AC for a little bit. I'm sweating. Uh, 243,725. 32% equals 609,350. People always complain that the rich people don't have to pay taxes. Trust me, rich people pay like 90% of the taxes out there. Like the top 5% of income earners pay 90% of total taxes. So if you make $11,600 as a single person, you pay $1,160 in taxes. So your net is $10,440. That's how much you take home. See if I did this right. If you made 47,150, I think I did something wrong, but I'll figure it out. So your first 11,600 is taxed at 10%. So if you had 11,600 in your gross salary, you pay 1160 in taxes. Your net income, how much you take and put in your pocket is 10,440. If you made 47,150 for the year, then you still have to pay 1160 on the first 11,600, and then on the next 35,550, you would pay, because you pay 12% on that 35,550. You don't pay 47,150 on 12%. You only pay 35,000, 12%, 11,000, 10%. A lot of So you would pay a total of 5426 in taxes on that 47,150. I guess that's kind of, are you guys with me on this? So if you made 47,150, you would pay 4266 in taxes. It's confusing, even me trying to do it. Okay. Okay. So if 47,150, you would pay a total of 5,400 in taxes. You would pay 1160 on the first 11,600. Then you'd pay 4,200 on the next 35,000. So total taxes would be 5,426. So you get a blended tax rate. I mean, there's no easy way to do this stuff. This will help me confirm I did the math right. Okay. So on the first 11,600, you pay a 10% tax rate because you pay 1160 on 11,600. Now, if you made 47,150, you only pay 12% on the amount above 11,600. So everything between from 11,600 to 47,150, you pay 12% on. So your blended tax rate will be 11.5%. You pay 10%. I wish it was an easier way to visually say that. I guess this column's kind of redundant because it's already in there. So if you made 47,150, you pay 12% on 35,550 and 10% on 11,600. So your blended rate is 11.5%. Now let's say you made 112,125. That means you pay 10% on 11,600, you pay 12% on 35,550, and you pay 22% on 64,975. So you would pay this plus this plus this. So you pay a total of $19,721 in taxes on $112,000. So your blended rate would be 17.6%. If you made $239,000, this is assuming no deductions, then you would only pay 24% on the amount where am I at? Above 100,525. See that? I made a mistake. Glad I checked this. Okay, here we go. So if you made 11,600, you would pay 10% of that. That your blended rate is 10%. If you made 47,150, you would only pay taxes 12% on the 35,550, which is the difference between 47,150 and 11,600. So your blended rate would be 11.5%, and you would pay a total of 5,400 in taxes. If your salary was 100,525, then you would only pay 22% on the 53,000. And because that's the amount above 47,150. Your blended rate will be 17.1%. Now, if your salary was 191,950, you would pay 91K on the 24%. So your blended rate will be 20.4%, and you would pay a total of $39,000 in taxes. And your net income will be 152,000. Yeah, this is all correct. If you make 243K, then you pay 32% on 51,000. So total taxes would be 55,679. Yeah, I did this right. I mean, this you don't have to do all this type of math for the test. It's much more straightforward than this. And if you made $609,000 for the year, you'd only need to pay 35% on 365,000, not on the entire 609,000. So your blended rate would be 30.1%. So you would never pay 35% in taxes no one, no matter how much money you made, say your income, just to show you mathematically, so this is your salary. Say it's 1.5 million. Let's do 15 million. For the hell of it. So instead of 609,350, I'm going to have 15 million is your salary. That means if your salary is 15 million, you would pay 35% taxes on 14.756 million, which is the difference between 15 million and 200. Oh no, it goes to 37%. What am I doing? There's no level. Okay. Okay. Let's do that again. So let's say your salary is $1 million. That means you hit the highest bracket. Everything above 609,351 gets taxed at 37%. I could have put it right here, salary. Okay. Okay, so if you made $1 million, you would get taxed 37% on 390,650. So anything above 609,350 gets hit at 37%. So you would pay $144,000 of taxes. So you pretty much pay 37% of 390 is $144,000. The first 11,600 you get hit 10%, then the next 35 12%, etc. So your cumulative taxes are $328,000. That's how much taxes you paid on your $1 million salary. So your net after tax is $672K. So your blended tax rate of 32.8%. So nobody could ever pay 37%, no matter how much money you make. It's impossible to pay. You could pay 36.99999, but you could never pay 37%. Because let's just say you, instead of $1 million, you made 10 million. So now your blended tax rate is 36.58%. It's getting closer to 37% because of the 10 million, 9.4 million you pay 37% on, and the rest you pay a lower rate. So let's just say instead of 10 million, what was it? So if you made $1 million, your blended tax rate. Let me get rid of this. It's so annoying. If you made $1 million, your tax rate will be 32.8%. Is that right? Yeah, 32.8%. If you made why is this not working? Okay, so if you made $1 million, your tax rate will be 32.8%. If you made $10 million, damn it. Let me just freeze this so I don't forget. If you made $10 million, your tax rate would be 36.58%. If you made $100 million, your tax rate would be 36.96%. So your tax rate can never be 37%, no matter how much money you make. Even if you made $1 billion, I mean, it does round to 37%, but it'll never. Does this excite anybody or just me? If you made, that's $1 billion, right? If you made $1 trillion, it's still not 37%. It's close, but it'll never be 37% ever again. It can't be. Because the prior, your initial earnings were below 37%. So it would get extremely close. It's kind of like in football. If you know that when you get a penalty, it's half the distance to the goal. Like it'll never be what's it called? Not a touchback. What happens? The 2-point play in the end zone. When the QB 2 points back of the end zone penalty. A touchback? No, it's not a touchback. Like if the quarterback is on a 1 yard line, and the end zone is right on his back, and he walks to the back of the end zone, or he gets tackled in the end zone, a safety. So it'll never be a safety, but they go half the distance to the goal. So if you're on a 20-yard line and the penalty is half the distance to the goal, now you move to the 10-yard line, and then the 5-yard line, then 2.5, then 1.25. You'll never go to the end zone. If it's always half the distance, it'll go to like the 0.00000, which I don't even know why I mentioned this. It just seems irrelevant, but so that's it. So your tax rate is a blended tax rate, so it'll always be below 37%. Chances are it'll be much lower because most people don't have a salary this large. Even if you're well off, you're probably still 24%. Some people here might be 32%, but I don't think that many people are making $250,000 a year or more. Actually, I'll be right back. Yeah, I took the week off of work this coming week because of the hair transplant thing. So we kind of beat that horse. No safety. But it usually wouldn't be much of a trick question anyway. It's usually pretty straightforward. But here are the rates. If you're single, these are the rates. But if you're married firing separately, it's much lower because each of you has, so like if you're married firing jointly, for instance, if you and your wife both make, or you and your husband both make 50K each, that's $100,000. So you would fall in this category. But it would be the same thing, 10% on the first 23,200, 12%. But if you're married filing jointly and say your spouse does not work, and you make $20,000, then you only get taxed 10% on $20,000, which is pretty nice. Because if you're single, you would get hit with 10% only on the first 11,000, then 12% on the next. So you save money by doing this. And they give you examples. So Melissa files as single and she has 32,000 of taxable income in 2024. I'm telling you, if you understand taxes well, it does make a lot of things easier. Not just filing your taxes, but Melissa files single, 32,000 of taxable income. All her income was from wages. This means she's in a 12% bracket, but that does not mean she will pay 12% on all her income. She pays 10% on 11,600. So it would be 10% on 11,600, so 1160. And 12% on the rest. So she makes 32,000 equals 32,000 equals 32,000 minus 11,600 times 0.12. So in her case, she would pay $3,600 in taxes on the 32,000. Hopefully they wrote that here somewhere. No, they didn't. But usually they wouldn't even have you do all the math. They would just, it would be something more simple. Like, how does she, they would say, how much does she pay in taxes? It would be something like 1160, 2,400, or 3,600. Something like more straightforward. You don't have to do like a ton of math. A lot of it you can do without a calculator. And there's another thing called the alternative minimum tax. Taxpayers must either pay the regular tax or the alternative minimum, depending on whichever amount is greater. The AMT is a little more involved. Okay, so the normal date to file your tax return is April 15th, unless it's a holiday or weekend, and it's a following business day. And the envelope has to say April 15th or before. Like if you file your taxes and it doesn't get to the IRS till April 22nd, it's okay, as long as the date on the envelope says. I mean, you should file electronically so you don't have to worry about that. But if you do mail it in and there's a delay in the mail, it's fine. It's really the postmark of the envelope. Let me know in the comments, is this helpful? I know some people take an EA exam. There's just a ton of things involved. I can make examples are really good because it kind of drives the point home. Okay, Serafina is an EA who specializes in handling tax returns. One of our clients is a single father to his 14-year-old daughter. On April 15th, right on the filing deadline. You know, we all need to know more about taxes. Taxes, when I ran my business, whenever someone asks, like, what do you do? What was your role in the business? I'd say everything except filing taxes. So I clean the toilets, I hired the employees, I did all the bookkeeping, meaning I kept track of all in QuickBooks, recorded all the income, expenses. I did all the payroll, every single thing I did. accept taxes. Although I wish I did taxes, but I wasn't. I could do my personal income taxes, but I wasn't that comfortable doing business taxes, especially when we moved here initially, because we had income from New York City where we worked. Then we had income from California. And we had write-offs because we started the business. So there was a lot of write-offs. So it wasn't really straightforward. But so 415, right on the deadline, Serafina attempts to file electronically, but is rejected due to someone already filing as a dependent. So if you have problems on the website, which happens, right? What if your internet is down? Then just mail it. As long as it's postmarked by April 15th, it doesn't matter if it gets there a few days late. Serafina promptly advises. So if this happens, if you file electronically, right, your tax return, so this person tries to file her tax return, but she's rejected because somebody else already filed claiming her as a dependent. So say for instance, okay, your name is Jamie, and you file a tax return, right? And you claim Mary, your daughter, as dependent. So Mary cannot file a tax return. Your daughter cannot file a tax return because you claimed her as a dependent. So in this example, there's a number of reasons why someone may claim you as a dependent. In this example, Serafina thinks Watson, her ex, suspects that his. Wait, Serafina. Oh, Serafina is a man. Oh no, sorry. Serafina is the accountant, the enrolled agent. One of our clients, Watson, who's a single father, tries to file a tax return and claim Emily as a dependent. And he is not allowed because you cannot claim, multiple people cannot claim the same dependent. Like I can't claim my daughter as a dependent and my wife claim my daughter. Only one of us can. We can't both get that deduction. So when Watson found out somebody claimed his daughter as a dependent, he just assumed it was his ex-wife, so she can get the credit. So he tells his accountant, Serafina, just file my tax return with paper format because that it can't be rejected if you file by paper format. I mean, if there's an issue with it, you don't get hit with a late fee penalty. They'll just contact you and say, oh, there was an error on your taxes. You have to fix this. He signs the return with an original ink signature before mailing them out certified mail. Watson return is considered timely and undergoes regular processing approximately later. So that's the situation. You can't claim, multiple people cannot claim the same person as dependent. Only one person can claim someone as dependent. But something that happens is that if you file, say you have a child, like 13-year-old child, and they don't have a job and they don't file a tax return, which is pretty common, right? Somebody, and this happens quite a bit, somebody may file a tax return for your child because they want to get like a $2,000 check in the mail. So they just make something up. Because if they happen to get a hold of your child's social security number, that's why you should always file your taxes. Some people don't file taxes. Like some people, even adults who don't work or they don't care, they just don't file their taxes. But if you do not file your taxes, then somebody may file and you would never know that. Free Tax USA is a lot than Intuit, in my opinion. So you want to file your taxes, even for your kids, you want to file their taxes because it doesn't, you don't want to risk someone filing taxes under your child because you would never know about it. And that could screw up things. And that happens a lot because there's a lot of shady people out there. And if they get a hold of all these social security numbers, then they file taxes for like 50 people and then they get checks for a few $100s. May request an extension by filing Form 4868, which may be filed electronically. The extension must be filed by the original due date. So you have to file the extension by April 15th. You can't, even though you're not actually filing your taxes, you have to let them know by the 15th. Or that's the worst thing, is not filing. Although an extension gives a taxpayer extra time to file, it does not extend the time to pay any tax due. So if you have money due, you must estimate and pay taxes. So if you're not sure, it's a good idea to just ask your accountant. Like I could figure it out myself if I was doing it, but if you're not sure, you can just ask your accountant. Like say you had, say you're just a college student, you made $15,000. And you know, let's just make it easier. Say $8,000, and you know the tax rate is roughly 10%. And but you just didn't have the time or whatever to file. You know, pretty much you're going to pay $800. You'll probably pay less because, you know, usually young people tend to get credits. Or I remember when I was a paper boy at 13 or 14, I paid like, I mean, how much did I pay? I don't know. Like I made like $100 a week, I remember. So 5,200. So I probably paid like $600 in taxes for the year. But I ended up getting money back sometimes because I was a kid. So they gave me a break. I don't know what it was, but you all can't use Free Tax USA if you live abroad, unfortunately. Okay, that's good to know. So you always have to pay your taxes, regardless if you file extensions or not. You have to get the money to the IRS, even if you don't know how much. Like I told you in this case, you made $8,000 for the year, roughly. So you know it's probably about 800 or less. So you just send in $800. If it ends up being $750, you get a $50 check in the mail. But if it ends up being like $1,200 instead of $800, not only do you have to pay $400 in taxes, then you have to pay a 10% penalty on top of that. So now you have to pay $440 in taxes, $440 to the IRS. You have to pay the $400 you shorted them plus a penalty. And then if you don't pay, like say you go years without filing taxes, you just keep adding these numbers up, and then it just, like say you should have paid, say you didn't file taxes for a decade, and you should have paid like $28,000 over that decade, right? But you're getting hit with 10% penalties and then 10% every year, and that $28,000 turns into like $75,000 because it's just the penalties keep compounding upon compounding, and then you're in a world of hurt because you cannot get away from the IRS. You can get away from a credit card company or a bank or anybody really, because there's not much a company can do. If you don't pay them, they can just keep hounding you. But the IRS, you can't get away from the IRS. They'll lock you up, not physically, but they'll lock up all your accounts. They'll restrict any money that goes to you until that you get paid. But there are exceptions to the filing deadlines, like that April 15th. So if you're in a FEMA zone, you have a postponement. So taxpayers in disaster areas, say there was a tornado in Nashville, and that's considered a FEMA disaster area. So, or even if you're not in a disaster area, but your accountant is in a disaster area, you do get the grace period of, you don't have to file on time. You get until, I don't know what it is, maybe October 15th. So if you're an individual business located in a disaster area, if your accountant holds your records in the disaster area, then you can get an automatic extension without filing for it. Relief workers who are working in the disaster, and like during COVID, if you were a doctor, you're a relief worker. You don't have to, even if you didn't file on time, you wouldn't get hit with a penalty. I mean, you probably would get hit with a penalty, but then you would just tell the IRS why you didn't file on time, and then they would remove the penalty. The IRS identifies taxpayers located in disaster areas by their zip code. However, taxpayer does not have to so you don't have to physically be located in a disaster area to qualify. Like I said, if you live in New York City, which is not a disaster area, but your accountant is located in a disaster area, then you do qualify. Taxpayers are also considered affected if the records necessary to meet a filing or payment deadline during a relief period are located in a covered disaster area. That's what I'm talking about. Affected taxpayers who are located outside the disaster area can call the IRS disaster hotline to figure out if you qualify. See, disaster relief can also apply to clients of tax preparers if their records that are required to meet a filing or payment are located in the disaster area. Do you do your own taxes? I don't. Before I had my businesses, I did, but I wasn't that comfortable once I opened these businesses to do taxes. I probably would feel comfortable today, but it was that first year I was a little unsure, because that when I first moved here, we had because we moved here in August from New York, California. So half our salary was New York City. So it's different tax rates. Half our salary was California. And then we started a business. So we had startup costs and we needed to depreciate the assets. And I just wasn't too comfortable with it. But I mean, my goal, the reason I want to take this test, this EA test, is when I get older, like 70s, 80s, I want to like do taxes for people, even if I'm not getting paid much, just kind of like to keep my brain working and to do something with my time. I just want to have some type of gig. If I don't have unless I have the business I currently have, unless I have that up and running. But me and Victor are going to do a hedge fund. We're starting a hedge fund, so that'll keep me pretty busy. But this is helpful, just talking about this, because it ingrains into my mind. I haven't been too motivated to study for this test. It's kind of like, it's a drag when you come home from work and you're tired to like do this stuff. So this is good. I'm doing it on a live stream. But when I do my taxes with my accountant, I'm pretty on top of it, and I'm able to help her or point things out for her too. Not that that's my job, but it's good to know this stuff, because if you don't really know what you're doing, it's kind of like when I go to a store and I pay for something, I know how much change I'm going to get back, just because that's just the way my brain works. So if they short me, like by accident, I would know it right away. Like I could see how much change taking, I would know it right away, which happens once in a blue, but not too often. But if you don't really know anything, then people can screw you over, and some people will do it on purpose or by accident. Okay, when a taxpayer is claiming a loss due to a federally declared disaster, they should write the FEMA disaster declaration number on the tax return. This helps the IRS process the claim correctly. Okay, June 15th deadlines, automatic 2-month extension. So okay, so it's a 2-month extension. So if you're in a FEMA zone, where are the FEMA zones? I hope this is helpful, because I would like to do more of these streams, because like I said, I have a hard time reading this material. I get bored and I'm tired out. So it's good to do it on a live stream. So flood zones are geographic areas that the FEMA has defined as according to varying levels of flood risk. So I guess if you go to the IRS website and you look up tax relief by date, so it looks like these are the states: Virginia, North Carolina, Tennessee. It's not the entire state, but I live in California. So let's say I only see one CA. So I'm going to click on here. And then, I mean, this is really what my accountant should be doing, but they have in their programs, it's all set up. They don't have to like reread this stuff. Their program should have all the information built into it. So it would already say if they're in a FEMA zone or not. I don't know. I don't want to go too much on a tangent on this one. What hedge fund? Hard to tell if you're joking. Oh, you know Victor H Investing. He called me up today, and he was like, because he wants to build a website, so you can like do a DCF model on his website. Like you type in a ticker and it calculates the stock price or gives you information. He's just trying to think of ways to like monetize his channel. But he has talked about starting his own hedge fund. So I told him, I think that could be a fun idea. And my friend, actually, a good friend of mine, is a lawyer, and he advises clients on starting hedge funds. So I was like, so I just contacted my friend. I said, let's just talk to him and see what's needed to do a hedge fund. I mean, it's kind of a far off goal. I don't know. I don't think we're going to really do it, but it's interesting. And if it doesn't cost too much, I think it might set us back about $100,000. No, $1 million. Because there's a lot of regulatory things like that, legal fees, how much to start a hedge fund. I think I read $1 million. Yeah. There are legal fees, setting up the base of operations, hiring staff, luring new investors, operational costs. Depending on the plan and setup, the initial costs range from $200,000 to $1 million. So it's doable. I mean, it's not like a small amount of money by any means, $1 million. But if he said, let's start building cars, then we're talking like $100 million just to get a factory, the infrastructure, you might need patents, trademarks. That's even starting, like, even if he said, let's start a supermarket. Let's open a supermarket. And that's a lot more than $1 million. That's probably like 15 million. So between the two of us, we would just have to $500,000 each. But I'll let you know how it goes. It's just fun learning about this stuff. I'm not going to, I don't have to spend any money. My friend is a lawyer, so we can just talk to him. It's not like, and you learn as you do these things. Okay. Okay. So if you're in a FEMA zone, you get 2 months automatically. You don't even have to you don't have to even do much. When you file an extension, you physically have to get the extension filed by April 15th in order to file by October 15th. But if you're in a FEMA zone, it's an automatic 2-month extension. So 3 groups of taxpayers are granted the 2-month extension: non-resident aliens who do not have wage income, U.S. citizens who are living outside the U.S. or Puerto Rico, and a man place of business outside of. So if you're a U.S. citizen, but I mean, you might be a U.S. citizen. Puerto Rico is not that close to the. I was thinking, if you're a U.S. citizen, like, say for instance, and I'm sure plenty of people, it doesn't even have to be. It could be, because when I lived in Buffalo, I could get to Canada a lot faster than I could to most places in Buffalo. It was literally a 20-minute drive to get to Canada. So there are plenty of people that live in the United States that work in Canada, like their regular job. Or there's plenty of people that live in US that work in Mexico. If there's a job across the border. So if you happen to be in Buffalo and you're really good at a certain thing, like you're a really good electrician, I don't know, and there's a company in Canada that pays a really nice salary for electricians, why not, right? Because like I said, it was literally a 15-minute drive to get to Canada. It was faster to get to Canada than get to downtown Buffalo sometimes when I lived in Buffalo. So yeah. So if you're a U.S. citizen and you're living outside the U.S. and your main place of business outside the U.S., you get automatic 2-month extension, because it takes time. Because in the U.S. your company has to provide you a W-2 by January 31st or 1099 by this date. But sometimes outside the U.S., it's not as timely. Another common thing is if you're on active military duty, if you're actively serving in Afghanistan, you automatically get that 2-month extension. So you don't have to file till June 15th. So December 15th filing extension. Hey, that's me. Moved from California to Switzerland. There you go. Yeah. Yeah, I'll definitely do a live stream with Victor, and we'll talk about the hedge fund. He talked about it before. I mean, we're both, I think, pretty established. I'm in my 40s. He's in his 50s. We both had pretty good careers. So I don't know. We'll see how it goes. I mean, could be a fun project for our last, decade or so of working. I mean, look at Buffett. He's in his mid 90s. I technically have 50 years of work left if I do what he did. Okay. So for most Americans and U.S. residents living abroad, the 6-month extension October 15th is sufficient. However, a taxpayer who resides outside the U.S. can request an additional 2-month extension beyond the 6 months, so they can get up to December 15th. So these examples are really helpful. Cosima is a U.S. citizen residing and working in Portugal. She has already requested a 6-month extension using Form 4868. However, she realizes she may require more time to ensure the accuracy and completeness of her return, as she is still waiting on essential financial documents from a Portuguese bank that has paid her interest. Luckily, an expatriate living abroad has the option to obtain an additional 2-month extension. So lots of things to remember. So if on a test, you might be asked some question like this. Okay, so special exception for combat zone. So if you're in a combat zone, is exceptions as well. So the deadline for filing tax return, claim for a refund, and the deadline for payment of tax owed is automatically extended for any service member, Red Cross personnel, accredited correspondent, or contracted civilian serving in a combat zone. So these people have their tax deadline suspended until 180 days after they leave the combat zone. So if you're in a combat zone, you have to worry about taxes. Once you leave the combat zone, then this clock starts ticking. So if you leave the combat zone on March 1st, then you have 180 days. So you have to get your taxes done by September 1st, 6 months after March 1st. The deadline provision also applies to estate, gift, employment, excise tax returns. These deadline extensions also apply to the spouses of armed service members serving in combat zones. So if you're in a combat zone, like I said, and you don't actually get out of the combat zone until March 1st, your wife does not have to follow. She also gets that 6-month extension from when you leave the combat zone. So she has also until September 1st. So you don't have to pay any taxes, and you don't get penalized. Ramon is a U.S. Marine who has served in a combat zone since March 1st. Oh, I picked March 1st just out of nowhere, and it's right here. So he's entitled to extra time to file and pay his taxes. The 46 days between the date he entered the combat zone and the normal April 15th deadline are added. So he has 226 days extension after he leaves the combat zone. Penalties and interest. See, I'm only on page 36 out of 480. There's so much to go over. The IRS can assess a penalty on individual taxpayers who fail to pay, or both. The failure to file is greater than the failure to pay. So even if you owe money, just file your taxes. File it by April 15th, but don't pay it, because you will get penalized, but the penalty is worse for not filing. Not filing is worse than not paying. The IRS will consider payment options for taxpayers. Failure to file failure to pay. So failure to pay. When a taxpayer does not pay the taxes on the tax return in full by April 15th, an extension to file does not extend the time to pay. So you still have to pay, even if you do file the extension. But what I'm saying is, don't avoid filing because the failure to file is worse than the failure to pay. So here's the failure to file penalty. The penalty for filing 1040 late is 5% of unpaid balance. So if you don't file by April 15th, say you file on 5/1. Come on. It's 5%. Say you owe $10,000. So if you file on May 1st, which is late, and you owe $10,000, then you get hit with a 5% penalty. So instead of paying $10,000, you pay $10,500. That's a failure to file penalty. If the return is more than 60 days late, the minimum penalty is the lesser of 5, 10, or 100% of unpaid taxes. So if you're more than 60 days late, you may pay up to $510 in penalties. $480. Wait, what do you mean 480? What are you referring to? Are you referring to this example? Because if it's more than 60 days late, so if you file, so it's supposed to be 415, right? 515, 615 is 60 days. So say you file on 7/1 and you owe $10,000. Then you have to pay a minimum. Let's just say you owe $200. That's your penalty. The minimum penalty is 510, or 100% of unpaid taxes. So it's a lesser of. So in this case, you have to pay a penalty of $200. So you pay $200 for your taxes, $200 for the penalty. But if it was $10,000, you'd have to pay 100. You would have to pay $510 as a penalty, because the penalty is 100% of the unpaid taxes. So you would double your taxes, but you can't pay more than 510. Okay, Lenny. I got to remember these little things. It's hard to remember. So Lenny does not follow his tax return on time or request an extension because he believes that he does not owe anything. When he finally gets around to paying, he owes $25 in taxes. He electronically pays the amount when he submits his payment, but the return is already 60 days late. So then he's going to get a bill for another $25, which is 100% of his tax payment. And on top of that, he will also owe a small late payment penalty of $2 because you have to pay interest also. Has Victor invited you to his Discord server? I'm a mod there. I think you should be a great addition. He probably did. I've never used it though. I don't know. If a taxpayer does not pay the taxes by the original due date, The taxpayer could be subject to a failure to pay penalty of 1/2%. Oh yeah, 410 pages. It's a long 480. Yeah, I know. And this is only one of the 3 exams. There's so much. So the failure to pay penalty is 1/2% of unpaid taxes for each month or part of the month. After the due date, the taxes are not paid, the penalty can be as much as 25% of the unpaid taxes. So it gets up there with the penalties. A taxpayer may request penalty abatement due to reasonable cause. The failure to pay penalty is reduced by the failure to pay penalty if both penalties apply. Lots of things to remember, right? So if your income tax due is $6K, you have a failure to file penalty, which is $810. So how do they come up with the $810? Okay, so $6,000 taxes due. You were 3 months late, so it's 1.5% each month. So 4.5% times 6,000 is $810. The failure to pay penalty is 3 months at a rate of $30, because the failure to pay penalty is 1/2% per month. And then you have to pay interest on past due amounts. So if you didn't pay a tax for like many years, the interest and penalties will be more, a lot more sometimes, than the original tax amount. Jimena does not have all the paperwork to follow, so she requests an extension. It's getting long. It's almost 3 hours. Interest on the amount due. In addition to penalties, the taxpayer will also be charged interest on the amount due. There's not that much math involved on this test. It's not like they're going to do. It's usually more straightforward. I think the CPA, there might be more math involved. Okay. Estimated taxes for individuals. The federal income taxes pay as you go. This means that people need to pay most of their tax during the year as they earn their income. That's usually through quarterly tax returns. You file, if you have like a business, you're a single member LLC, your accountant may say you have a business that roughly has 10,000 of profit a quarter, so 40,000 for the year. Your accountant may say, just send a check to the IRS every quarter of $2,500, just to play it safe. My state doesn't require me to file quarterly if I don't owe any. Well, it depends. If you're a W-2 employee, if you work at a job, you pay each paycheck. Taxes come out of each paycheck. But if you have a small business, it depends on how much money you make. Also, you may be required to pay quarterly. Some businesses have to pay monthly. Taxpayers can avoid making estimated tax payments by ensuring they have enough tax withheld from their income. And there's different rules. The 90% rule: pay at least 90% of the tax owed for the current year. So if you owe less than $1,000 in taxes, you don't have to pay anything until the year is over. You don't have to pay quarterly. You're a contractor? I wonder why you don't pay taxes then. Oh, because if I don't owe, you owe less than 1,000. Okay, so you qualify for the 1,000 rule. Oh, you're an independent contractor. You do the Amazon deliveries, right? Okay. No, no prior tax year liability. So if you had no taxes in the previous year, then you don't have to pay taxes this year. So yeah, so those are pretty straightforward. They have examples. So Edgar earned $4,700 before he was laid off. He did not file a tax return or pay income tax. He started working as a self-employed rideshare driver. He paid no estimated tax during the year. He files his 2024 return in March and discovers he owes $5,500. So if last year you had no taxes, you didn't pay anything in taxes. This year, you don't have to pay taxes until the year is over. You don't have to pay estimated taxes. Even if you owe a lot of money, you won't get penalized. Although the following year, you will have to pay estimated taxes. Here's something funny. I hire someone for my US taxes now, but do my own Swiss taxes because they are simple in comparison, even with the return all in German. That's the US. It's very complicated. They don't make it easy. That's funny. That's really interesting that you can do it in another country in a language you don't know. Because there's so many, because everybody complains in the US. So if like powerful people complain, then you have then they make all these changes to appease those people, and then other people complain. And there's these different safe harbor rules. So here are the tax due dates for most people. April 15th is the first one. The second payment is June 15th. You get the 2-month extension. So if you have a small business, right, like I was saying earlier, say you have a small business and you make roughly $10,000 a quarter, so you pay $2,500 taxes. So you have to pay the $2,500 by April 15th, then another $2,500 by June, September, and January. Those are the 4 times you have to pay it. You could pay earlier. You could pay all $10,000 on April 15th and not worry about it. But as long as you pay by these dates. I'm just reading this example. So farmers and fishermen have a different rule. Farmers and fishermen do not have to pay estimated taxes. If at least 2/3 of someone's salary is from farming or fishing, they do not have to pay estimated tax, assuming they filed their return and paid all their tax owed by the So, and if a farmer or fisherman has to pay estimated taxes, they don't have to pay it till January 15th of the following year. So say a farmer or fisherman is in this boat. They make $10,000 a quarter, which comes out to $40,000 for the year. So $10,000 of taxes they have to pay for the year. As long as they pay it by January 15th of the following year, they're all set. They don't have to pay anything throughout the year. It's so many nuanced things. So that's farming and fishing. Backup withholding. So not everyone has to file a tax return. So if you're single, like you're 18, and you just started college or finishing high school, and you work at a pizzeria and make $5,000 a year, you don't have to file taxes. You don't have to file a return. It's still a good idea to file a return because, like I said, with that fraud thing, if people are filing returns under your name, you would never know it until you filed a return. So it's still a good idea. Of course, if you're paying somebody to file your return, you may not want to pay them, $1,000. But if you're doing it yourself, you should definitely file it. If you're doing it for your kids, I would definitely do it. But here there is no IRS equivalent. Each state has its own IRS. Basically, it's like the U.S. was the Articles of Confederation. Yeah, it's interesting because a lot of people who work in the U.S. do not want to file taxes as a U.S. citizen because, say for instance, you live here in the U.S. and you make $30,000 on a job. Well, what's the threshold? Say you're below the threshold, $7,000. You just have some side gig. If you report that income, you can't just report your U.S. income. You have to report all your income. So if you have businesses in other countries and you have millions of dollars of income from those other businesses, you would have to report all that income and pay taxes in the U.S. on that income. You can't just pay taxes on the $7,000 of income you make in the U.S. So that's why a lot of people who live here don't want to file taxes in the U.S. unless, of course, they have to, because the U.S. will rape you. Okay, so the gross income adjusted for inflation, divided by age. However, there are situations where taxpayers may still be required to file even if their income falls below. Alexis, a freelance graphic designer who works on various projects of the year. Elena, 65, 35 wage income. Her husband, Ricardo, 65. They have no dependents. Would have a filing requirement because their income is under. However, Elena wants to file separately from her husband this year. So this is an example of what I was talking about. So Lana has 3,500 of income, and Ricardo 19,600, and they have no kids. Normally, Ricardo and Elena would not have a filing requirement because their gross income is under the threshold for people 65 and over. What's the threshold again? So 65 and older. It's 32,300. So say this couple, they're over 65, and their combined salary is 23K, which is under the 32,300. So they do not have to file. However, Elena wants to file separately from her husband this year. So Elena, if you're married, you could do married filing separately or married filing jointly. It's up to you. Now, if you do married filing separately, the other spouse has to do married filing separately because they can't be different. So, and the reason sometimes people do this is if Elena and Ricardo are kind of like getting close to divorce and Elena thinks he's doing something shady, she doesn't want to be involved in that. So she can file separately in case he's doing something illegal. That's a reason. So Ricardo's filing status is married filing separately by default, since both spouses are required to sign a joint return. Because in order to do married filing jointly, both you and your spouse have to both sign. So you can't do married filing jointly and not have the other person sign a document. So they both required to file a tax return because the filing threshold for marrying filing separately. So once Elena says, I've chosen to file MFS, that makes Ricardo's decision MFS by default. And the threshold for MFS is $5. So if you make marriage filing separately, if you make above $5, you have to file. You can't. And he makes well above $5. He can't just not file. Which could screw him over, because if he has a lot of money in other countries from other businesses, he has to file that in the US and pay taxes on all that. Okay. Believe me, I know my old colleague was a Brit who married a US citizen when they started filing together. It was a nightmare. Yeah, it could get real confusing for sure. Filing requirements for dependents. For a child with only unearned income, the first 1,300 of unearned income is not taxed. The next 1,300 is taxed at the child's rate. Anything above 2,600 is then taxed at the parent's rate. So the kiddie tax. So for a child, okay, so when I was a paper boy, I probably made more than 1,300 though, and that's not unearned income. They're talking about unearned income. Okay. So the kiddie tax. The kiddie tax is only on unearned income. So the examples are usually good because it gives you an idea of how it works. So Chloe's 10 years old and lives with her mother. Chloe inherited stock when her father died a few years ago. So she received $1,100 in dividends. Unearned income is when you receive income without working. So it's dividends is a common one. It could be gift from a relative. It could be interest if you own a bond. You could sell a stock too. That's unearned income if you profit from that. So the kiddie tax. So she could. Good luck. Oh, thank you, Shadow Guy. Very friendly. Appreciate it. So the first $1,300 of unearned income is tax-free. So she pays zero in taxes on those dividends because she's a kid. If she was an adult like us, you have to pay long-term capital gains, probably like 15% or so. So let's just say it's 1,300. Let's just say she earned $1,600. So 2023, $1,100 of dividends from her father's stock that she was given. And then next year, $1,600. It's probably going to change each year, but let's just pretend it's still $1,300 of kiddie tax. So she has to pay $300 taxes on $300 because the first 1,300 is tax free. But what's our tax rate? It's the parent's rate. So she's not subject to kiddie tax rate, and she doesn't have to file a return either if she doesn't pay taxes. For a child with only unearned income, the first $1,300 is not taxed. The next $1,300 is taxed at the child's rate. I don't know what the child's rate is. It's probably somewhere in here. And then after that, all the money is taxed at the parent's tax rate. Lot of nuances, I know. Parents 17-year-old sections. Getting tired. Over 3 hours. See, it takes up forever to the parent's tax rate. Dang, that's kind of unfair for a child. Yeah, the parent's tax rate. So it would be hard to find. So if the parent was a head of household and they made, say, $150,000, it would be a 24% tax rate for the kid. That's any. So 0 to 1,300 equals no tax. 1,301 to 2,600. I don't know what the kid. I'm sure mentions it somewhere. Okay, that's taxed at the child's rate. I guess the child's rate is because the child would be single, so the child's rate would be for a single filer, so it would be probably 10%, unless they made over 11,600. So they pay 10%. And anything above 2,600 would be. Did I do that right? Yeah. Okay, so anything above 2,600 is then taxed the parent's rate. This is the kiddie tax. The kiddie tax only applies to investment income and other types of unearned income. We cover the kiddie tax in more detail in Unit 15, additional taxes and credits. It's funny. It set the timer. But I'll probably remember this better now that I'm doing it right here. If I get it on the test. I don't even know why I'm taking the test. It's just, I don't even think I'm gonna do anything with it. But okay, for a dependent child who has received more than 14,600 of earned income also needs to file a return. The total cannot be more than the standard deduction for their filing status. So if you're a child and you earn more than $14,600 of earned income, is income from a job like a W-2, or it could be you're an independent contractor. Like there are these kids in the neighborhood that wash cars, So they go to people's homes and they charge $100 and wash their cars. Or if you mow people's lawns, that's earned. So unearned income, it could be rental income if you own a property and you receive rent from your tenant. That's unearned income. Lottery winnings, dividends, which is probably a pretty popular one. The interest on a loan, even like if you're divorced from your spouse, say your spouse makes a lot of money and then you divorce them and you receive alimony from them, $1,000 a month. That's unearned income. Unemployment benefits is unearned income. If you get an inheritance, someone dies. Capital gains if you sell a stock at a profit. Pensions, IRA distributions. Yeah, if you have an IRA, you're 70 and you take $1,000 out a week, that's unearned income. Yeah, there's a lot of ways to unearn income. Earned income, I guess that's just work. Wages, salary, tips, bonuses, and commissions. Yeah, that's just work. But even if you're a child and you get more than 14,600 of earned income, you have to file a return. If it's below 14,600, you do not have to file a return. But the examples are really good. It kind of helps it put into context. Barrett is a 17-year-old student living with his parents, earned $5,650 part-time job, received 200 of dividends from stocks. And his parents claim him as a qualifying child. His total income is below the filing threshold. His investing income is also below the filing requirement. So he's not required to file a return in 2024, and his parents can claim him as a qualifying child. Even if Barrett is not required to file a tax return, he may still choose to file to receive a refund of any taxes. So it's a good idea for him to file, even though he doesn't have to. Elizabeth is 19 and is claimed as a dependent on a parent's tax return. She's a full-time college student. She worked part-time, earning $14,950. She had no other income. So she's not subject to the kiddie tax because all her income is from wages. All the money she made, nearly $15K, was at an ice cream parlor. And her income is above 14,600. So she has to file. But her parents can claim her as a dependent. You can claim people as dependents and they can still file their own returns. So if you're self-employed, if you earn more than $400, you have to file. But that's net self-employment earnings. So like for me, if I earned $2,000 from YouTube for the ad revenue, and let's just say I had $1,500 in expenses from what's it called? Like I have to pay for like Simply Wall Street subscription, say all these subscriptions I pay for, and I don't know what else. Let's do more. 1,700. So my net earnings from is $300. So I don't have to file. All self-employed taxpayers report their earnings on Schedule C, profit or loss for business. So you guys probably 1099s. That's what I receive from Google. They send me a 1099 with my ad revenue for the year. So if you work at a company that doesn't hit you with taxes, they just pay you whatever you charge them. Like if you went to a business and painted their store and charged them $2,500, and they just cut you a check for $2,500, they should give you a 1099 form so you can use that to file your taxes. Of course, not all companies do that, and it's your responsibility to still report that income. Okay, I'm getting tired. It's a long stream, right? Hope you guys got some use value from it. I guess I did. I don't know. Yes, it's good to talk about this. Without doing this, I probably wouldn't have studied much. Okay. Till next time. Thanks for joining. Appreciate it. I'll talk to you later.